Watching YouTube and the finfluencers gave me this idea that for investing directly into stocks, you need knowledge and expertise. But when it comes to investing into mutual funds, you can get away with ignorance. That is far from the truth. Mutual funds are made up of stocks. Investing in a mutual fund without understanding what kind of stocks make up the fund could be dangerous. In case of most mutual funds, downside risks can be minimized by staying invested for long periods of around 5 years. However, there is a certain category of mutual funds in which the buy and hold strategy could be disastrous. These are the cyclical mutual funds and they are meant for the short term. The strategy of this category of mutual funds is betting on the business or economic cycles. The cyclical nature makes them highly risky and that's why these funds are not very popular. But in the last 2 years, these funds have been booming. Asset management companies have been launching a lot of new funds in this category and their assets under management are growing manifold. Increase in the assets under management means one thing for sure: more people are investing into them. Hence, more people need to be made aware of the nature of these funds. Expansion and contraction of the economy happen in cycles. India is clearly in the middle of an economic and business expansion cycle. If these cycles can be understood and taken advantage of, big returns could be possible in the short term. Some of these mutual funds have generated more than 80% returns in just 1 year. But there are risks. In this video, I will be discussing the opportunities and risks associated with these mutual funds. And be sure to subscribe so that you don't miss future videos on how to properly invest in the stock market. Namaste and welcome to Retail Investing. These business cycle mutual funds invest in those businesses which are expected to benefit from the expansion of the economy. The Indian economy is in a rapid expansion mode. Big asset management companies like Axis, HDFC and Kotak have launched schemes in this category. 2.5 years ago, the assets under management of these funds was roughly 500 crore rupees. Today, it is more than 18,000 crore rupees. All economies, including the Indian economy, fluctuate between periods of expansion and contraction. And this keeps happening in endless cycles. Each of these cycles can be divided into 4 phases: growth or expansion, peak, recession, and trough or depression. We can get an idea of where we are in the cycle using macroeconomic indicators like gross domestic product, interest rates, and unemployment. For example, in the growth phase, interest rates are low, which makes credit easily available and lots of jobs are created. The exact opposite happens in the contraction phase. The economic cycle is also called the business cycle, but there is a subtle difference between the two. The corporate profits do get strongly affected by the economic cycles, but some companies' revenues are affected more than other companies, which means superior stock picking skills are required to choose the right stocks from the right sectors. The business cycle mutual funds take a top-down approach to investing. This is almost the same as macro investing. So the fund managers first take a look at the sectors which are expected to undergo a business upcycle or expansion, and then specific stocks will be added to the mutual fund. Asset management companies are bullish on sectors like banking, capital goods, industrials, manufacturing, and real estate. Their strategy is to identify themes and sectors which can generate good returns in the next 1 to 2 years. That is how they plan to implement the top-down approach. Before looking into some of the mutual funds and their returns, let's understand the opposite style of investing, which is called the bottom-up approach. Bottom-up investing focuses on individual companies and their fundamentals like revenues and profit margins. In bottom-up investing, it is assumed that fundamentally strong companies can relatively outperform their underperforming sectors. Bottom-up investing does not give much importance to macroeconomics and market cycles. It is the preferred style of investing of most successful investors. And using this approach, they have found wonderful companies with a long-term secular growth potential. But that is not the topic for today's video. Here is a list of some business cycle funds. The ICICI Prudential Fund, being the largest in terms of assets under management, has given 16.8% returns in the last 1 year. The Tata Business Cycle Fund has done really well recently and has given 23.3% returns to its investors. The HSBC fund has been the most consistent in this category with a CAGR of almost 26% in the last 3 years. This is another category of the cyclical funds. The government of India is sharply focused on the development of infrastructure. If you look into the latest budget, you will find that the capital expenditure outlay was 10 lakh crore rupees, and that's an increase of over 35% in infrastructure spending by the government. This could make a strong case for the infrastructure mutual funds. India's growth story is fueled by sectors like construction, cement, metals, oil and gas, capital goods, and power. There are around 18 mutual funds focused on these sectors, and all of them are a decade old. So we have their performance data for at least 10 years. Here is a list of mutual funds from well-known asset management companies. As you can see, the year 2014 witnessed stellar returns by these funds. The Franklin Build India Fund gave 93.8% returns that year. The Kotak Infrastructure and Economic Reform Fund gave over 80% return. The HDFC Infrastructure Fund gave 73.9% returns. These numbers are magical. However, in the following 2 years, that is in 2015 and 2016, the magic totally vanished for these mutual funds. But some of the funds even gave negative returns. 2017 was another year of extremely high returns for these mutual funds. A return of over 40% seemed average that year. The next year, that is 2018, was devastating for these mutual funds. Almost all the funds destroyed investors' wealth. The HDFC Infrastructure Fund destroyed almost a third of the wealth of their investors that year. The next 2 years, that is 2019 and 2020, saw low single-digit returns by these mutual funds. The Quant Infrastructure Fund was an outlier and gave over 32% returns in 2020. 2021 was another year of stellar performance. A 50% return seemed average. The Quant Infrastructure Fund gave 83.22% returns that year. The Bandhan Infrastructure Fund gave over 63% returns. And most of these mutual funds are heavily invested into small and mid caps. I hope you got some idea of the level of risk versus return from the past performance of these mutual funds. ICICI Prudential has both a business cycle fund and a flexi-cap fund, and as of July, 50% of the stocks were common in both the funds. The common stock percentage was the same in case of HDFC's business cycle fund and flexi-cap funds as well. This means that the flexi-cap funds are also making sectoral and cyclical bets for superior performance, but their risk level is lower than that of the business cycle funds. In case the cyclical bets work out really well, the flexi-cap funds cannot generate returns as high as the business cycle funds. So each individual investor needs to make a decision based on their risk tolerance level. There is one more thing that investors must keep in mind before taking a decision. During economic and business expansions, the companies which are the market leaders usually take away most of the profits. Investing in the market leaders can generate easy and healthy returns, but that would create a fairly concentrated portfolio. However, as per SEBI regulations, equity mutual funds are not allowed to make a single stock more than 10% of a scheme. So these business cycle funds are not even allowed to bet heavily on a few stocks for generating superior returns. Based on the past performance, it could be assumed that these cyclical funds are meant for holding periods of only 1 to 2 years. I personally prefer staying invested for at least 5 years in a mutual fund because longer holding periods dramatically reduce risks, and I won't have to pay capital gains taxes every year. Plus, when it comes to making cyclical bets, I prefer buying stocks directly. Since 50% of the stocks are common in flexi-cap funds and the cyclical funds, I would prefer the flexi-cap funds because of their lower risk levels. If you got something valuable from this video, please like, subscribe and share. And don't forget to type in the comment section what kind of mutual funds do you prefer. Thank you very much for watching this video, and I'll see you in the next one. Jai Hind.